Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Let's talk about the FOMC minutes. It's different than the FOMC meeting, the meeting we had back in December. We have another FOMC meeting coming up in February, but this is the minutes. What is the minutes? The FOMC releases minutes, which is basically a summary of the discussions that they had in December. Now, since the minutes come after the meeting, it sometimes tends to be updated or tweaked here and there to basically disseminate certain information to the markets if their message didn't come across in a perfect manner during the meeting. They will use the minutes to make sure that the markets and that the market participants understand where the Fed's head is at when it comes to monetary policy. And sometimes these minutes may be just as is, which usually it is. Nothing new in terms of what's being expected in the minutes. And sometimes the minutes are used to tweak certain things because maybe the markets got out of hand. Maybe the markets took a very dovish stance in the last meeting, and the Federal Reserve probably didn't like that, right? So this minute, right, the minutes that came out, it was more tilted to the hawkish side, and some of the comments were basically, to me, I felt that it was in line with expectations of what the Fed has been saying, but if you do look at how the equity markets have traded, it was basically a yo-yo in the markets where the markets sold off initially, then picked back up to P1, and then after later in the day sold off again, and then picked back up. And it was just really back and forth, a lot of confusion in the equity markets on these minutes. Now, with what the mainstream media is talking about online about the minutes, a lot of them have said, and there are some points that I will also mention that I thought were also hawkish as well, and that I do agree with. But basically, to summarize what the minutes said, is that Fed did come out and admit that a recession is plausible in this year or later this year. So that was something that was interesting. And another one is that, which was, I think, even more important, is that the Fed pushed back against any unwarranted easing expectations. And I think this is the key. I think this was the biggest point in the minutes that kind of gave that hawkish tone. So what does that mean? Unwarranted easing. So what did the minutes really say? So I'm going to read it here for you. Basically, in the minutes, it says, participants noted that because monetary policy worked importantly through financial markets, an unwarranted easing in financial conditions, especially if driven by misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. So what does that mean? Basically, that means that what the Fed is saying here is that the markets that are creating this unwarranted easing in financial conditions, all right? So these are the words that he used, that is in the minutes. Unwarranted easing in financial conditions. What is financial conditions? It relates to the stock market, right? So how is the stock market creating easing conditions? Well, if the Fed comes out and says that we're going to raise rates, and we're not going to raise rates as we did in 2022, where we did jumbo rate hikes, but we're still going to continue the pace of raising rates, but we're just going to be very careful with it. And the stock market goes up, and equity prices, and you get all these asset prices moving up, that is creating easing conditions. And the Fed came out and commented that the market that is completely offside and completely reading this wrong saying that this unwarranted easing in financial conditions is a misrepresentation. The market is not getting it, the public is not getting it, that the Fed the Fed is not talking about any dovish tone, is not giving any dovish tone, and also doesn't like to see that any easing is happening in the markets. And it's in fact making it more difficult for the Fed to conduct its monetary policy. So in other words, they're basically saying, hey, stop buying the dip. So stop buying the dip in the stock market, stop buying in the dip in equity, stop buying the dip in NFTs, in crypto, in Bitcoin, in ARK, or in your whatever you're interested in your all of your risk asset bubbles, right? Stop buying the dip, because this is creating unwarranted easing in the financial conditions, and the Fed does not like to see that. So this was one of the biggest points in the minutes that caused that kind of a little bit hawkish tilt. And from this, according to Bloomberg Intelligence Fed Minutes Sentiment Indicator, so Bloomberg has this crazy indicator that basically measures how dovish or hawkish the Fed minutes were, and basically that indicator said that these minutes were the most hawkish since May of 2022. So pretty hawkish, you can imagine, according to this index, right? So that was the biggest point. That was a key point, that hey, stop. They're going. If you're going to create easing conditions, if there's going to be some sort of growth, some sort of strength in the markets, then guess what? They're going to fight back, because, like I mentioned in a previous video, in a Wall Street Journal article, one of the Fed members came out and said it's required by the law to do what they're doing. It's a mandate for them to bring inflation down to 2%. And when you read the minutes and you read through all the articles out there online, you hear that the Fed is not backing down. And they're trying to really send out this message that we're not backing down. We're going to go to 2%. We're not going to change our opinion and say, hey, okay, we got to 3%, so let's leave it off here. Or we're going to play a little easy and say, okay, let's change our goal to 4%. No, 2% means 2. And that's what also they mentioned in the minutes, that all of the participants basically agreed that yes, we need to see inflation go to that 2% level. Now, other things that were mentioned in the minutes, basically saying, very important here as well, slowing rate hikes is not pivoting, right? So this is what I've been saying last year. I've been saying that this equity market rally, these massive rallies that we're seeing, right? That the equity markets are betting that a pivot is coming, and that this rate cut is coming because the Fed is talking about slowing down the pace of the rate hikes. Basically, they mention it here in the minutes that, and they didn't say it the way I said it, but I'm summarizing it for you, that they're saying slowing rate hikes is not pivoting, basically saying that, slowing in the pace of rate hikes increases is not a weakness of the FOMC from saying that they can't reach price stability. Right, so it has nothing to do with that. So they're saying, in other words, they're saying that, stop thinking about the pivot. Stop thinking that we are going to reach and do this rate cut all of a sudden just because you want NASDAQ to be higher, or just because you want Bitcoin to be higher. The other thing is, in the minutes, there was some disconnect between market and the FOMC, saying that several participants commented that medians of participants' assessment for the appropriate path of the federal funds rate in the summary of economic projections, which track notably market above base measures of policy rate expectations, underscored the committee's strong commitment to returning inflation to its 2% goal. So again, in other words, saying that, hey, again, there's a big disconnect with what the market is thinking and what the Fed is trying to communicate. They're saying that, hey, we want to get to 2%. We are not going to cave in. We're going to reach to 2% and we're going to do whatever we can to reach there. Now the market's like, hey, I'm calling your bluff. Now, hey, the market can be right, but in order for the market to be right in terms of the real pivot coming, that would basically mean that something has broken. Something in the economy has broken, and then yes, the inflation has come down to their 2% target. But if nothing has been broken, then they're not going to cut rates. Simple as that. Other than that, they said also they want to preserve flexibility and optionality, which basically means that we're going to be data dependent and see how data is, and depending on that, we will either pause or continue to raise rates or whatever. It's all dependent on data. A few also mentioned about wage price spiral. They also mentioned that risks with, I think it was I'm trying to look here. I think it was a shelter. So one is the wages, the other is, I think, shelter and rent that continues to be elevated at high levels, and they want to see that come down. And other than that, like I said in the beginning, they also viewed and said that a possibility of a recession sometime over the next year is plausible. So they did mention that, could happen, this recession. So a mention of that in the minutes as well. They also mentioned a little bit here about unemployment rate, but still would want to see. They said certain section, the minority group in America has seen a jump in the unemployment rate. They still want to monitor that as well. And other than that, the JOLTS data, they also mentioned about the job openings, said that the data is moving down in October. However, the data that we got just recently basically showed an upward revision. And so that's also, another reason to continue to be hawkish. And the last but not least is from Bloomberg Economics. This article from Bloomberg, they basically mentioned that, quoting that a lot of the staff sounded more alarmed about nominal wage growth than in previous FOMC minutes. So they were hinting that the underlying pace might be running at 5% and wages continue to move up because the vacancy to jobs ratio started to move up. There's still strength in the labor market, like we see in ISM employment as well. And because of that, that's creating elevated wages, and that's another problem. So overall, the biggest thing is that, yes, the Fed's going to continue unwarranted easing expectations. If you think that the stock market is bouncing and they're going to like that, no, they're not. So sum it up. What does the Fed minutes really say? Is that stop buying the dip. Stop buying the dip. That's what the Fed is basically saying. Otherwise, we're going to continue. Otherwise, we're going to hike rates. Otherwise, we're going to get to 6%, 7%, 8%, 9%, 10% until you stop buying the dip. That's not my words. I'm just translating what the minutes are saying. Anyways, leave a comment. Let me know what you guys think. Hit the subscribe, like button, and I'll see you guys around. Cheers. Bye.